Welcome. This is the October webinar from Principal Wealth. The title of this is Crunch Time as we are entering the last quarter of 2024. I'm Julina Ogilvie, partner and wealth advisor here at the firm, joined by Bob Paolucci, our founder and CEO. Bob, welcome.
Happy October.
Happy October. We have leaves on the ground. The weather is getting chillier and there is a lot going on.
And the election is almost here.
It's almost here.
and eventually it'll be behind us.
It will eventually be behind us, and we will talk about that today. Just to quickly share the agenda, we're going to follow our cadence where we're going to talk about the markets, the economy and policy, and then everything else.
Yeah, there's lots of fun we're about to get to, so let's dive in.
Okay, let's do it. We're going to start with the equity markets because we are sitting at all-time highs, and the question always arises, where do we go from here?
Yeah, Julina, we're not too far away from our 30th year in this business. I can't believe I'm saying that.
Thanks for the reminder.
I need to start dyeing my hair more. So again, approaching 30 years, and for 30 years, we oftentimes hear, is the market too expensive? How is this sustainable? Can it last? Can it last? And if we really break it down, we hear it more often coming out of a bear market and into a bull market, right? When the change in direction is very sharp, right? We went from a decline to an incline. We are now just about a month away from our second year in a bull market. That's all, right?
Yes.
This is almost the second full rolling year in a bull market. And bull markets tend to last about 8 years.
Right. A lot longer than bear markets.
Yeah, bear markets last about 8 to 10 months.
Correct.
Doesn't feel that way, but that's actually what it is. And what you have is valuations, so PE ratios, which oftentimes people use to say the market is cheap or expensive. You probably shouldn't anymore. We're going to cover that singular topic maybe over the next month or two. There's some interesting data to it as to why we think you can't use 30 and 50-year data and compare it to today. It has to do with the makeup of the market. But generally speaking, the rule of thumb is, a PE ratio of about 20 is fully valued. And that's roughly where we are right now, right?
Yeah.
But when you open the doors, the saloon doors, to get granular on the makeup of the market, and in this case, we're using the S&P 500, and you really break it down into these small little slivers, the top 10, the next 40, the next 50, the next 100, so on and so forth. It is the top 10 that are the most expensive from a price to earnings ratio standpoint. But they're expensive because they grow earnings exponentially greater and faster than generally all the other companies, right? So if there's a group that you want to pay a premium for, historically, it is these bigger, higher quality, liquid, hyper growth companies. And that happens to be the top roughly 10 companies of the S&P 500. So they trade at a higher valuation. The higher valuation is, you pay a premium for premium growth.
Correct.
Make sense?
Absolutely. And that's what they've done for the last couple of years.
Yes. So they are factually more expensive than the rest of the market, but for pretty good reason. Mm-hmm. Now you have the rest of the market. And the rest of the market actually trades at a discount to the S&P 500. And
meaning the 490 stocks in the S&P.
By the rest of the market, I'm talking about 99% of the market.
Correct.
It's cheap relative to the current valuation of the market. So what this tells us is there's a lot of catching up that the market will do because it's cheap. People like discounts. And these are also high quality companies that are liquid, growing their earnings, so on and so forth. Not all of them, but most of them. So there's a lot of depth, breadth in the market, and that is very good. It's a very good foundation to have going into the next few years. So there's very likely some growth catch up that should happen in other sectors outside of technology and in other parts of the market outside of the top 10 that we're already seeing. Actually, in the past 3 months, technology has been one of the worst performers. It's not awful, but a lot of the other sectors like utilities have done some catching up. So just a little heads up for you. The market is not, through our lens, overpriced, and it has quite a long runway, our view.
I would also point out that in the last webinar, we talked about the fact that Wall Street is expecting the earnings growth for the next couple of years to be much more diversified
Mhm.
amongst these 490 names and not just prevalent in the top 10, which
Yeah,
also leads to the growth.
if you were paying attention for the last video, if you watched it, one of the slides illustrated forecasts for earnings of mid caps, small caps, and the smaller large caps to exceed the earnings growth of mega cap companies. In this case, we're referring to the top 10. So if that happens, great. If it doesn't, it's going to be close. Either way, it's a good scenario.
It's a good scenario.
Yeah.
We also talk a lot about dividends.
Right. So we were talking about this before this video. When you invest in a stock, right, you own shares. You own shares of a company, right? You're a shareholder of a company, small shareholder of a company, but you are a shareholder. And what companies tend to do, big or small, is if there's excess cash, that excess cash comes out to you as a shareholder. It doesn't have to, but many companies, after they account for research and development and things that they're going to do over the next year, next 3 years, next 5 years, they pay some of their debt. They plan for their business. If they still have cash left over, they do shareholder friendly activities like pay dividends, increase dividends, buy back shares, so on and so forth. So generally speaking, you more often see that happen when there's lots of liquidity, there's lots of earnings, there's a forecast for more earnings and more net income on the horizon, right? You don't want to be a company that is just paying a dividend if you're losing money, right? You better be prepared to not increase your dividend and or suspend your dividend. What we're seeing here is the complete opposite, right? The trend is, in aggregate, these companies are doing quite well. They have lots of cash. They're making lots of money. They're making the right decisions. And they're rewarding shareholders by paying out incrementally higher dividends each year. This is a very good sign, a very healthy sign for businesses in the United States, publicly traded. In this case, we're highlighting the S&P 500.
Absolutely.
Yep.
And let's add to these good signs because we now are in a cutting cycle from the Fed.
How
And
about
what does
that?
that do? What does that do to risk assets?
So the Fed cut rates, we'll talk about that in a minute. But for now, we'll talk about the impact of rate cuts on assets, in particular, risk assets. And by risk assets, we're talking about, generally speaking, stuff outside of a money market. That would be short-term bonds, municipal bonds, high yield bonds, stocks. What you see is 1 month out, 3 month out, 6 months out, 1 year out, 2 years out, 3 years out. We could keep going. The impact of rates going down provides appreciation for risk assets. And we think that will continue to be the case. We're not going out on a limb here with this one. And there are reasons for it that we can maybe talk about in other videos. But generally speaking, on the bond side, we'll keep this simple. If you owned a 6% bond coming into the Fed cutting rates to a lower level, well, if your bond still exists, it's generally speaking worth more because the new environment offers yields that are lower.
Mhm.
Everyone wants your higher yielding bond, so it is price adjusted up. That makes sense?
Correct.
All
Yes.
right. So there's a very basic view of bonds, incredibly basic. But that is generally speaking what happens to many bonds, not all. That's one. Number two, when you look at the stock market, the prices of securities generally reflect the future earnings of a company discounted to the present, right? So take future earnings and bring them back to present to come up with a price. And you have to use an interest rate to calculate the discounting to come up with a price. When you use a high interest rate, you come up with a lower price. When you use a lower interest rate, you come up with a higher price. Magic. Magic.
Yeah.
Now, it's not all that, but it's a good part of that. There are other things like lower rates means higher affordability, indirectly more liquidity, other things means, it's a very stimulative thing. And there are other benefits from it as well. But generally speaking, lower rates, higher asset prices.
Yeah, and the only comment I wanted to make on this is the blue bars of the S&P. All of the other bars are different types of bonds. And it's amazing to see that you can get double-digit returns in bonds as the Fed cuts rates over the next possible number of years. And I say this because we are at the highest levels of cash we've ever seen as consumers, and you don't get an appreciation in cash. So just wanted to point that out.
And actually, in cash, you get a depleting return because they are directly tied to the Fed cutting short-term rates.
Yes. Thank you for saying that.
And of course, for compliance reasons, Julina, we are not making any promises. This is
Thank
looking
you.
backwards. We'll leave it at that.
Yes. But I think as the Fed continues to cut, the goal is that we're going to a more normal environment. So what does that mean?
Yeah, interesting slide here. I had to really stare at this one for a minute. We show this because the Fed is the cycle that they are in right now is a normalizing cycle, right? What does that mean? Well, the Fed increased interest rates because the economy was hot and could tolerate higher rates, and those higher rates will assist in bringing down inflation,
Hmm.
right? Mission accomplished. And they brought rates, they said this, to a level that was far beyond what they think is normal. And they are about to bring rates down to normal. So this is a normalizing cycle. The markets love a normalizing cycle because it actually says to them that the Fed is aware and cares about the level of rates,
Hmm.
and getting to room temperature interest rates rather than being too low or too high. They're being very mindful.
Hmm. Yes.
Just the fact that they're mindful, the markets love it. Number one. Number two, normalizing rates means, hey, we're addressing the fact that rates are too high. We're going to bring them down lower. And this Fed is so willing to chart out their path.
Yes.
Um, they're sharing what their plan is, and
Exactly.
you go back to like Alan Greenspan, he intentionally would just keep talking until you stopped listening. He didn't want to tell you what they were doing. He wanted to keep you on your toes. He wanted to keep businesses on their toes, right? He wanted them to weather themselves and prepare for anything. Now you have, the three most recent Fed chairmen and women have over articulated what they see, what they think, the path, so businesses sort of can plan maybe a little bit better,
Hmm.
and that seems to be working out okay. So here you
And this
have,
shows their transparency.
yeah, this shows their transparency, right? So normalizing cycles on the last slide showed, things usually work out very good in the markets, in the economy, and this is showing you the Fed's articulate path. And hey, if you're going to talk about what you're going to do for the next year or so, the market's also going to start to price it in, right? And the market has it priced in almost the same as what the Fed is saying. But the difference is the market realizes, hey, looking back at prior cycles, when you gave us some information about what you're going to do in the future, what you plan to do, you always did it, but it was always done quicker. And you always did a little bit more than what you said. So guess what? That is exactly how the market has it priced in. The Fed plans to cut rates from where they were in August. Remember, they cut in September, where they were in August, by about half, right?
Yeah.
They're going to get down to about directionally 2.75 to 3.25, somewhere around there, right? Just call it 3%.
Hmm.
The market agrees, generally speaking, on the slightly lower end. They just say you're going to do it sooner. And by sooner, they think the Fed is going to be wrapping up their plan by the end of 25. The Fed says, we're going to probably do it by the second quarter of 26, but close enough. So
Yeah, the
that's
market really is in alignment with the Fed right now.
absolutely.
Yeah.
Yep.
Yeah. And
As aligned as it has been.
fair point. Yes. And I know, Bob, how obsessed you've been about reading the language of the Fed.
Yeah, all you have to do is listen, right? And trust me, it's not that easy. It's painful to listen to this stuff, but here is the change. They pivoted in September, and this is their written statement. There's a lot of red. There's a lot of scoring out score lines here. There's a lot of change going on. Yeah, because they dramatically changed policy.
Yeah.
And if you want to see what a pivot looks like, well, here it is. This is the language. This is the statement. Tons of change.
A lot of change.
Yep.
And a lot of times when we talk about the Fed, you hear dual mandate. So what does that mean? And can you talk about how that there's been a little transition here?
Yeah, you're starting to hear more about the Fed's full duties. So they have a focus of price stability and employment. Price stability is inflation and employment, right? So the dual mandate that they have, you almost forgot they also worried about employment because over the past year and a half they were only talking about inflation.
Inflation was all we heard.
Now they're not really talking about inflation. They are worried about and talking only about employment or unemployment.
Correct.
And this is a chart of the number of Fed members who think there's risk to higher unemployment. And if you listen to us in the past, you know that we firmly believe that the US economy was in a recession in the first and second quarter of 2022. It just wasn't called,
Defined.
defined. Yeah.
Yep.
It wasn't knighted a recession by the group that usually does it. We had two consecutive quarters of negative GDP growth. All the economic data looked awful, with the exception of unemployment.
Mhm.
Uh, Anywho, well, the worries about unemployment rising or risk to the upside are here again. So, with 12 members worried about risk to the upside of unemployment, hence, you had a 50 basis point cut in September.
Yes.
So, if they keep worrying about risk to unemployment, they'll keep cutting. And if you see the worry number of members worried about risk to the upside rise, you could see another 50 basis point cut on the horizon. I don't think they'll do another 50 basis point cut, which in my view is two cuts in one.
Right.
In November, I think we're good for a quarter and another quarter in December. So I think that means the second half of this year, in particular, since September, probably through December, you'll have the Fed actually do four cuts or one full percentage point.
Yeah.
I think they'll do the same, maybe a little bit more throughout 2025. And I think they'll be done.
Okay.
Yep. And that gets us rates down to about 3%. And I think that's a good new line in the sand for room temperature interest rates.
Yep. As the Fed is telling us they believe they're going to do. So,
Yeah. Eventually, you're going to hear them bring that up, that the terminal rate or target rate or neutral rate, it's all the same, is 3%, right?
mhm.
You'll hear probably more about that in like 6 months, unless in the commentary and or the Q&A after the Fed meetings, the media asks about it.
Yes.
They're probably going to ask about other stuff, at least for the next couple of months. You'll hear about the neutral rate, the ending point, where are we going to stop? And the Fed will have to have a good answer for it. They should say, we don't know yet, but we think it's around 2.5 to 3.25.
Okay.
Um, if they say something too high, the market will react to it. If they say something too low, the market will
The
react to it.
market. Yes,
So they're going to
exactly.
have to really think about the narrative they want to play.
Absolutely.
Yeah.
Yep. And with all eyes now on employment, we can take this one step further and get a tad more granular.
Yeah, so the Fed is acknowledging the fact that parts of the economy are pretty weak, getting weaker, right? And it's
Hmm.
really through our lens. We're generalizing here, but let's say it's the bottom third of the consumer, right? Those who have elevated debt, paycheck to paycheck or worse. What we're seeing, we look at this stuff, but these are FHA single family mortgages, and there's a increase in delinquencies, and those increases when someone doesn't pay their mortgage or they ask for an extension, there's a questionnaire, oftentimes in writing, oftentimes also over the phone. Can you tell us why? They just want to document the reasons, right, to track what's going on. I actually think it's a smart thing that they do, because they can pick up on trends. And the trend that you're seeing here is, you're hearing the respondents say they're unemployed, they have excessive obligations, and there's a reduction of income. Well, they're all tied together, because if you're unemployed, your obligations are excessive because you have no income, right? Or less income. So that's something to monitor. And I believe that that trend over the past, we've been looking at this for the past year, saying, hey, the economy is weakening a little bit. I believe the Fed started paying more attention to this. And why do I think that? Well, 50 basis points doesn't do anything
Hmm.
except for help the mortgage market, right? So
Right.
you now have mortgage rates, which were at over 8%, mind you, not too long ago. They're now in the low sixes. And some banks are offering a teaser high fives rate for an adjustable rate. What does that do? That allows refinancing of higher rate debt to come down fixed at a much lower rate. Now, it's slowly becoming more affordable, and I think that trend will continue. So I think the
Yeah.
Fed is aware of this, because they know 50 basis points, 25 basis points, those don't do anything. Those are rounding errors. What it generally means is you're going to make less in your savings account, money market account automatically. Treasuries will yield a little bit less. The big assistance is in like car loans that are astronomically high, credit cards that are astronomically high, and mortgages that are pretty high in absolute terms, very high in relative terms, right? Because if you were used to 2.5, 2% mortgages, 3% mortgages, now all of a sudden you're hearing 6, 7, and 8. Oh my
Yeah.
word, that's quite high.
Yeah.
Even though if you've been alive long enough, that's kind of a normal interest rate. That doesn't matter. It's relative.
It's all relative.
Relative
Absolutely.
to 5 years ago is relative to 3 years ago is relative to 10 years ago. That's just
Yeah.
the way.
Yeah. And so with that said, let's take a look now at the housing market.
So that relative change in rates was so big that
Mhm.
people with 2 and 3 and even 4% mortgages would be foolish to move, especially if you have to maintain some debt when you sell a house, pay off a mortgage to get a new house and have a mortgage. Why get rid of a 2.5% mortgage and get into a 7.5% mortgage,
Yes.
right?
Absolutely.
Uh, the question is answered. We wouldn't. There is no why. We won't do it.
Yeah.
And what that then creates is an incredible amount of undersupply of housing, because nobody is moving. There are no listings. So, we always try to point out extremes.
Mhm.
And, when you reach extremes, you tend to mean revert back the other way. So, right now, we're looking at very likely what's about to be reversion to the mean of housing supply. What's going to help with that? Well, number one, time, right? You'll get impatient waiting to buy a place, and then eventually things like we have to move, or we have to do this, or we're having another child, we need another bedroom. That stuff will take precedence, of course.
Yeah.
But right now, it's really driven by the cost of money. So as we see mortgage rates come down, we will very likely see undersupply turn into, from way under to neutral, and then from neutral probably to a little bit excess supply. We think that's going to happen pretty quickly, and we think that it's all going to sort of start in the spring of this year and this upcoming year and play out probably for the next 24 months.
Right.
So get your cardboard boxes, your bubble wrap, hire a mover now, for the move that you don't even have planned yet, and rent a storage facility. That's my
Yeah.
best advice because it's on the horizon.
Yeah. I know a lot of realtors excited about the comments you just made, but it's also interesting to see how regional the markets can be in housing.
Yeah, I mean, this is pretty up to date. This is as of last month, or about 50 days ago. Interesting chart, regional and then national. You have a chart of color coded where buyers outnumber sellers, Northeast. On the opposite end of the spectrum, this changed rapidly, is Southern Florida, right? So sellers outnumber buyers in Southern Florida. Hence, there's a lot of listings now, and you're starting to see price declines. The Northeast, there are just no homes for sale. So, tons of buyers waiting to move around, to jockey for position into, better neighborhoods, better schools, so on and so forth. So a wide disparity across the country with these percentages. It's just for your reading pleasure here. Take a peek at it. It is true. And I think most of you would agree based upon where you are. The real estate market, you can't just define it nationally, right? You really have to look at the region, in some cases, the sub-region, to see how wildly different it is.
You really do. Yeah,
Yeah.
absolutely. And let's transition really quickly and over to China.
Okay. Uh, so
And
we put this in here because it's been in the news a little bit.
yeah,
China, which we believe we've talked about this, but we believe China's been in a recession that they don't talk about, of course, or don't admit
right.
to. We believe they've been in a recession for 2 years, maybe even longer. Keep in mind, China, when they report their economic growth, right, they say we grow at 5% every year. It used to be seven, but now we downgraded it to five, but we still grow at 5% every year.
It's like the straightest line we've ever seen.
They don't change it.
No.
Right. It's amazing how their math works. So in essence, it's like they show you this chart of growth, and if you're not pleased with the outcome, they flip it upside down and they say, "Well, actually, we meant to say this." Right.
Yes.
Whatever you want to hear, they'll tell you.
Right. So you have to look under the hood to see what's
You
really
have to
going
look under the hood. So they just announced, you know, various flavors of stimulus, whether it's cutting rates, whether it's selling bonds to create cash, whether it is telling the banks they don't have to have as much on in reserves, whether it is subsidizing some consumer goods, whether it is allowing. So for years they've had this, I believe, two or three home max purchase of real estate. Right? They didn't want the real estate market to get out of control. They got rid of the cap. So now you can buy as many properties, generally speaking, as you want in China. They're trying to stimulate the economy, right?
correct.
And 10 years ago, this would have been an investment that we made already, and we're telling you about it now. But 10 years later, we seem to be reversing globalization. And, we had this trend with China where we were becoming, we were giving them our jobs and our low hanging fruit stuff and starting to rely on them more and subsidizing them, helping them become who they are today to a degree, right? At least economically. We created that growth. Without us, there would not be that growth, just so you know. They are an export based economy.
Mhm.
We're a gigantic customer.
Yes.
Eventually, their consumer will rule their economy and there'll be a consumption based economy, but they're not there yet. They're getting there. So, to help them get there, they are providing stimulus to their people, right? They're updating key monetary policy, some fiscal policy, some other bizarre real estate policy. They're trying to do a lot of stuff to stimulate. Well, why would you do that? Are you in a recession? Oh, no, of course not. Of course you are. You're in a recession. I mean, that's like you can prove it. So, this is here because the Chinese market stock market over the course of about 10 days went up about 20%. Well, it was cheap and it probably still is cheap. The only problem is, as we reverse a little bit of this globalization and we're talking about taxes and tariffs and we're talking about delisting Chinese securities from the New York Stock Exchange and we're talking about China being less friendly with us and us being less friendly with them, this is a thornier investment nowadays.
Correct.
And there is some real risk investing overseas. So I don't think this is investable yet. It's something that we're watching, uh,
Hmm.
because there are some unique risks out there that we haven't seen in a long time. We're monitoring it. We just bring it to your attention because there's some stuff happening over there.
Absolutely.
Yeah.
That's great. Thank you. And let's transition into the last part of the agenda, which is the everything else bucket.
Everything else,
And
where all the fun happens.
yeah. Yeah, and this has been in the news a lot with everything going on with the port workers. So let's walk through that.
Yeah, I mean, if you're going to go on strike and you really want to have leverage, do it 30 days before an election and do it when we just stopped talking about inflation. So, the Eastern ports, let's call it, they went on strike. How timely. All of a sudden, the strike was solved. And by solved, they got pushed out post-election into mid-January. So it will be for the current administration to deal with or a new administration to deal with, but get out of the way of the election. Uh,
Correct.
so in essence, what they got was an agreement to temporarily agree to, all their terms for now,
For
uh,
now.
and then we'll readdress it. Keep working, and we'll readdress it in 3 months or so. So we'll talk about this more, but you can see the Eastern ports are responsible for a lot of stuff, and it could put the economy in a pickle for a short amount of time if things don't get resolved quickly.
Yeah,
So something to be mindful of, something we're very mindful of. So
exactly.
that can has been kicked into January, and we'll address it probably in the next month or two.
Okay. And good news for anyone taking Social Security?
Hey, Social Security was the annual reset for COLA happens in the calculation happens in October, and then it gets implemented in January. So starting January, those receiving Social Security will receive a 2.5% increase, which is down substantially over the past couple of years. Why? Because inflation is down substantially, and it's tied to inflation.
Yeah.
So a small increase is coming to Social Security effective January 1st, based on the October this month's number. You can go to
Yes.
Social Security's website and you can see all this data. That's exactly where we pulled it from.
Yep. And this is our last webinar talking about the election. We are weeks away.
Wow, what a shame. It's almost over, Julina. So, in talking to our clients and in talking to every human being on the planet, we listen. And what we hear and also what we think is policy, social policy, talking points have become more extreme, right? The gap between ideology has widened, right? We seem
Yes.
to be distancing ourselves from each other, and our ideas are also getting a little wilder somehow. Well, so is policy. So this is an interesting chart that measures the voting record of the current candidates and prior presidents, right? And what you can see, we drew these black arrows to help you understand it, is yeah, policy and political ideology has gotten wider and wider and wider and more detached from one another and from the middle over time.
Yeah.
It's very wild. So we shouldn't be shocked that we're listening to extreme stuff on television, in the paper, in the news, in social media, probably where there's the most extreme stuff.
Mhm.
And we're having conversations that are a little bit more difficult. The holiday season is upon us here, and just about everyone I've talked to over the past handful of years, almost 10 years now, have said, look, we don't invite Aunt Rita and Uncle Joe. We stopped talking to a couple of friends. We just can't do it anymore. And that's a shame. I hope one day we get closer to the middle, and I hope one day policy finds itself in a position to appeal to most.
Mhm.
And I'm optimistic that when we hit these wide extremes, again, we tend to mean revert back. I think we'll get there. It can't happen soon enough. It usually happens, fingers crossed, but I do find it wild that the best we've done with policy is to get somewhat close to the middle. And that's where the biggest want is. And we just can't seem to get it. How
Yeah.
about that? How
How
about
about
that?
that? Yeah.
So,
Okay.
so this will continue, and we'll be talking less politics over time. But before we do that, we'll talk a little bit more. How about the next slide?
Yeah, and since you've already referenced how long we've been in the business, I'll take it a step further. I know you titled this slide. I don't know if you listened to Black Sheep in high school, but I couldn't help but think of them when you titled this "If This Then That."
We're going into the Wayback Machine for that one, Julina.
Yeah, I know.
I do
Yeah.
know what you're talking about, and yes, I did listen to it.
Okay.
You're right. It's what every action has an equal or opposite reaction, right? There
Yes.
are consequences when you tinker, when you change things, so on and so forth, especially in the US economy and especially in tax code. More specifically, actually, corporate tax code.
Hmm.
So the top left chart is quite interesting. It measures red line and gold line the tax rate, the corporate tax rate of the US versus the rest of the world, generally speaking. Okay. And starting somewhere around late 80s into the early 90s, the rest of the world figured out, hey, our tax rates are too high. We want to get more business, right?
Yeah.
And they did. So they cut corporate tax rates, and businesses woke up to this somewhere around the mid 90s. And you started to see this rise in something called a tax inversion. What's that? Well, that's when a US company gets acquired by or acquires and takes the domicile of a foreign company,
Correct.
right? It's like, hey, we bought a Swiss company. We're going to use your address now, and we're going to abide by that country's tax code.
Yes.
And from the mid 90s up until 2017, 2018, we saw a rise in tax inversions. It ended right around the end of Obama's term. And there was one company in particular that a rule was written specifically for. I say specifically for, government will deny that. If you all remember, Pfizer was trying to, how about this one, acquire a smaller company and use their home as their new address for tax purposes. So the company was Allergan. They made, I believe at the time, Latisse and some other popular drugs. They were located in Ireland. So Pfizer was counting the dollars saying, wow, this is going to save us a fortune, right?
Correct.
And then Obama wrote in this rule sort of last minute. And then Pfizer was prepping to, rid themselves from Connecticut, in essence, and the other parts of the country that they were in. And then all of a sudden they didn't. And then all of a sudden corporate tax decreased significantly, and we haven't had a single inversion since then.
Yeah.
So now there's proposals out there for higher corporate tax code. Higher corporate tax code is going to mean, look, businesses are for profit, right, wherever they are. And U.S. businesses are portable. They can up and leave unless you write some code that prevents them to do it.
Mhm.
And when they leave, they tend to bring their people with them. And if their people don't want to go, well, that's a choice. But that certainly creates more unemployment. So, you got to be very careful with corporate tax code, something to be mindful of. And these charts, I won't address any other one other than the top left. You just look at them and, you know, create the story you want to create with them. You just have to be careful. There's a certain level with corporate tax where these big businesses will say, thank you,
Hmm.
we're moving.
Yeah, absolutely.
So you have to be
Yeah.
mindful of that because they are, in aggregate, big employers.
Yeah. It's a very important point. One other point with the election, which I think is so interesting, is how individuals vote by state.
This is interesting. What's most interesting is the spread
Hmm.
between high turnout and low turnout states. You all get to fill in the blanks. We have no talking points other than it's an interesting chart.
Yeah.
There's a 70% voter turnout in Oregon, and there's a 38% voter turnout in West Virginia.
Hmm.
Wild. What a gap. You fill in the blanks as to why there are gaps. I'm sure there are thousands of reasons and ideas.
Yeah.
But it'd be nice to have full participation
Yeah.
in our elections, but that's not the case.
And if you're looking for Connecticut, we sit in a very rounded 50% number.
That's right.
And then one last point on the election is talking about the various outcomes.
Yeah. So, Juliana, what we've talked about this for the capital markets. These are the markets, right? The capital markets, what do they care about? They don't really care about who's in, they care about policy. And through that lens, they care about the new rule book. How many pages are going to change? Is it going to be a whole new book? Is it going to be the same? We're trying to plan for the next 3, 5, and 10 years. Please tell us as soon as you can what the new rule book looks like. And once they get it, they figure out a way to ad- adjust to it, right? They'll
Hmm.
adjust their business a little bit to it and be done with it. So you have to understand that through the market, what's going to happen? Well, what's going to happen is what's always happened is it really doesn't matter so much. And things generally tend to be good for reasons other than politics. Like, is there liquidity in the system? Are interest rates at a decent level? Is there optimism? Are we creating jobs? Are we manufacturing stuff? Are we consuming goods? what are the demographics? There's a lot of other stuff that is significantly more important than politics, right?
Absolutely.
It just doesn't sound like that because the amount of money that's spent on political stuff, warning that the world's going to end if the other party takes over, and vice versa, it gets to you, it makes you believe it.
Yeah.
Well, that's never been the case, and I don't believe it will ever be the case. Businesses will figure it out. So if you're worried about the capital markets look pretty good.
Yeah. And I would just add too, this is not the only slide addressing this. We've seen countless slides from a lot of different money managers, economists suggesting the same thing. So
Mhm.
this is just one example of it. So thank
That's
you.
right. Yep.
And we have one last slide, which is just as always as a reminder when we have these all-time highs and people start to get emotional that time is your friend and stay invested.
Well, it's the odds are in your favor.
Yeah.
I know it feels like the market goes up 50% of the time and down 50% of the time. I mean, this is over a 100-year span, 98 years. It's
Hmm.
positive 72 years.
Yeah.
In the positive years, remember, get away from the averages, including down markets, but the average positive year in the stock market alone is 21.4%.
Hmm.
It's up, roughly 72% of the time. It's down the rest, which is small, relatively speaking. The average negative year is down 13%.
Correct.
The odds are in your favor, the numbers are in your favor. The capital markets do good things often.
Yeah.
And when they don't, it's down for a short period of time, infrequently, and then it takes over again and starts going up. So
Yeah.
this is reality. And we show you these subtle things because there's a difference between what you think, right? Oftentimes in reality, and the delta, the gap is usually emotion, confusion, oftentimes bad behavior.
Yeah.
So if we can show you the truth often and articulate to you how we make decisions, what we're looking at and why, and guide you and educate you and remind you that we think we know what we're doing, it's better for you. It's also better for us too.
Yeah.
We like to feel good about the stuff that we're doing. So
Yeah.
hopefully, watching this, Julina.
Well, I also think that we live in a world of averages. We always talk about the average return. So for example, the average return for the last 98 years of the S&P is 10.3%. But yet when you look at the calendar year returns, we only have 2 years in 98 years that the market landed from January to December at 10%. So I also think we live in a world of extremes. So when the media loves to pretend like the market being up 20% is so extreme, that's the reality. We live there. So
Right. It's a very good point. Well
yeah.
said.
Well, thank you, Bob, for all of the comments. And I would hope that the listeners can hear from us our continued optimism for the economy, even though it might be slowing down a little bit for the markets going forward, especially as the Fed continues to cut. And I'm also very excited that our next webinar, we will be talking about the election post and some of the outcomes that we can look forward to there.
It's crunch time.
As always, we are here. If you have any questions, please feel free to reach out to any of us at Principal Wealth and look forward to seeing you next month. Thanks, Bob.